In times of uncertainty, one asset always returns to the spotlight. Gold. A safe haven. A hedge. A symbol of lasting value. But is now the right time to buy? Let's break down the key forces driving gold and why buying on dips might be your smartest move in 2025. Gold has always held a special place in the world of finance, not just as a precious metal, but as a timeless store of value. But in today's climate, its significance is intensifying. Right now, several powerful forces are converging, and they're all pointing in one direction: upward momentum for gold. Let's break down the key drivers that are shaping this bullish outlook. We're in an age of global unpredictability. Whether it's fears of regional economic slowdowns, rising tensions in the Middle East or Asia-Pacific, or the ripple effects of political instability across continents, uncertainty is everywhere. And when uncertainty rises, so does gold. Investors traditionally move towards safe haven assets, and gold sits at the top of that list. As fear spreads, demand for gold climbs, pushing prices higher. And with no immediate end in sight to geopolitical flashpoints or economic fragility, this tailwind is likely to persist. Even as some central banks claim progress in taming inflation, core costs remain stubborn. From food and energy to housing and services, prices are still biting. Gold thrives in such conditions. As inflation erodes the real value of money, gold's reputation as a hedge becomes more valuable. When currencies lose purchasing power, tangible assets like gold become essential for wealth preservation. Inflation, in essence, is silently fueling a steady surge in gold demand. Central banks worldwide are significantly increasing their gold reserves, reinforcing gold's role as a cornerstone of financial stability. In 2024, central banks collectively added over 1,044 tons of gold to their holdings, marking the third consecutive year of net purchases exceeding 1,000 tons. Why? They're looking to reduce reliance on the US dollar and build resilience amid global instability. This official demand isn't speculative, it's strategic, and it puts a solid floor under gold prices, providing long-term upward pressure. The People's Bank of China, PBOC, has been a prominent buyer, adding 44.17 tons of gold in 2024, bringing its total reserves to approximately 2,280 tons. This move is part of China's broader strategy to diversify its reserves and mitigate risks associated with the US dollar. Other notable central bank purchases: Poland, India, Turkey, Kazakhstan, Czech Republic, Qatar, and Egypt. This widespread and sustained central bank demand underscores a global shift towards gold as a reliable store of value amid economic uncertainties. The strategic accumulation by these nations not only supports higher gold prices, but also signals confidence in gold's enduring role in global financial systems. Gold and the US dollar have a historic inverse relationship. As the dollar weakens, gold strengthens, and today, several factors are threatening the greenback. Rising fiscal deficits, political gridlock in Washington, and concerns over the sustainability of US debt. If the dollar declines, gold becomes more attractive globally, not just as a hedge, but as a currency alternative. A weakening dollar unlocks new demand from international buyers, adding fuel to gold's rally. Trade wars and tariff threats don't just disrupt commerce. They trigger uncertainty and inflation. Whether it's new duties on essential goods or retaliatory measures between major economies, the result is the same: higher prices, slower growth, and shaken investor confidence. This environment is a perfect storm for gold. Tariffs drive inflation. Trade wars fuel uncertainty. Both strengthen the case for holding gold. As global trade policies shift and tensions escalate, gold becomes a strategic asset, not just a defensive one. While gold is fundamentally supported, investors, particularly short-term traders, should be aware that not every crisis immediately triggers a gold rally. Historical exceptions reveal the complexity of market behavior. At the onset of the pandemic, gold prices initially dropped. Why? Investors entered a full-blown liquidity crisis, a dash for cash. They liquidated gold alongside stocks and bonds to cover margin calls and losses elsewhere. But as central banks responded with rate cuts and stimulus, sentiment shifted. Gold then surged over 27% from January to August 2020, peaking above $2,000 Oz. It served as a textbook safe haven, but only after the initial panic. On the 2nd April 2025, when reciprocal tariffs between major economies were announced, markets braced for inflation and disruption, traditionally bullish for gold. But in a twist, gold prices dropped sharply between 3rd and 5th April, catching traders off guard. The sell-off was likely triggered by algorithmic rebalancing, a stronger US dollar, and profit-taking ahead of anticipated central bank moves. These two episodes underline a critical truth. Even strong fundamentals don't guarantee immediate price surges. Sentiment, liquidity needs, and short-term flows can overpower long-term logic. While the broader picture strongly favors gold due to inflation, central bank demand, and global uncertainty, short-term volatility remains a reality. That's why a buy-the-dip strategy works best for long-term positioning, not speculative day trading. Waiting for emotional pullbacks, rather than chasing momentum, gives investors the best chance to accumulate gold at attractive levels. Gold remains the world's most trusted safe haven, but even gold needs time to shine, and timing, as always, is everything. When it comes to investing in gold, there's no one-size-fits-all approach. Depending on your risk appetite, time horizon, and trading experience, there are multiple instruments available. Let's break down the most common and accessible ways to buy gold in today's financial markets. Gold can be traded as a CFD through reputable brokers, many of which are regulated across multiple jurisdictions. Opening an account is usually quick, and CFDs offer high leverage, making them ideal for short-term or day trading strategies. However, there's a cost to holding positions overnight, known as swap fees. Most brokers charge a daily rollover fee if you keep your long gold position past market close. While leverage amplifies gains, it also magnifies losses, meaning there's a real risk of losing your entire account balance if trades go against you. Best for experienced day traders. Watch out for swap fees and account risk from high leverage. Futures contracts offer another way to trade gold, particularly on exchanges like COMEX. These instruments are highly liquid and widely used by professional traders. But futures trading comes with its own complexities. High capital requirements if you intend to hold positions for weeks or months. Exchange fees, data subscriptions, and regulatory costs. Significant leverage, which, while powerful, increases your risk exposure. For retail traders, especially those without institutional scale capital, gold futures may not be ideal for long-term holding. Best for professional or institutional day traders. Watch out for high margin requirements, and fees. ETFs offer a convenient, low-maintenance way to gain exposure to gold, especially for long-term investors. These are traded like regular stocks on major exchanges and often come with zero brokerage or maintenance fees, depending on your broker. Here are some well-known gold-related ETFs. SPDR Gold Shares, GLD, tracks the price of physical gold. iShares Gold Trust, IAU, holds physical gold with a lower expense ratio than GLD. VanEck Gold Miners ETF, GDX, invests in gold mining companies rather than gold itself. Keep in mind, ETFs do charge annual expense ratios, so it's worth reviewing the specific fees before you invest. The benefit? Unlike buying stock in a single company, ETFs are diversified. If one miner fails, the ETF's performance is cushioned. Best for passive investors seeking diversified exposure. Watch out for expense ratios and tracking error. If you're comfortable selecting individual companies, gold miners can be a powerful leveraged play on rising gold prices. Unlike ETFs, stocks don't charge annual expense ratios, and reputable miners offer potential for capital appreciation and dividends. Here are a few established gold mining stocks to consider. Note, this is not financial advice, just general information. NEM Newmont Corporation, AEM Agnico Eagle Mines Limited, RGLD Royal Gold Inc., Gold Barrick Gold Corporation, KGC Kinross Gold Corporation, Sandstorm Gold Ltd. These companies often have low PE ratios, strong analyst ratings, and, if gold prices continue rising, are well-positioned to generate robust free cash flows. Among them, Agnico Eagle Mines, AEM, consistently receives positive reviews for operational efficiency and asset quality. Best for investors looking for long-term gold exposure through equities. Watch out for company-specific risks like debt, management quality, and geopolitical exposure. Before we wrap up, a few things to clarify. This video is for educational purposes only. I'm not a financial advisor, and none of the instruments or companies mentioned here should be taken as investment recommendations. I do not own shares in any of the stocks or ETFs discussed and have not reviewed their annual reports, earnings, or debt levels. My commentary is based on market positioning and macro context, not deep financial analysis. Please always do your own due diligence before making any investment decisions. There's no perfect way to invest in gold. Each method has its pros and cons. What matters is aligning the instrument with your goals. CFDs and futures, fast, flexible, high risk. ETFs, simple, diversified, moderate fees. Stocks, long-term upside potential, no ongoing costs. In my view, if you believe gold is heading higher and you're not a day trader, ETFs or mining stocks offer some of the best ways to hold gold positions with fewer fees and more stability. If you're looking for an asset with enduring value, hedge-like characteristics, and fundamental tailwinds, gold deserves a place in your strategy. And buying on dips may be the most effective way to build exposure.